We're running a little bit late already, so that's apologies in advance. Our first speaker I'd like to welcome to the stage is Danny Thomas from CBRE Agribusiness. Danny's a Regional Director of CBRE Agribusiness and is responsible for a multidisciplinary team of over 40 agribusiness portfolios. CBRE Agribusiness is a division of CBRE Group, who are the world's largest commercial real estate services and investment firm. So Danny's going to give us a bit of a talk today about the current rural property market in Australia and what's driving demand, what the threats are to market entry, and the one that we all want to know the answer to, how to get funds in a post-banking Royal Commission world. Could we give Danny a big round of applause, please?
Thanks, Meg, for the kind introduction, and thanks everyone for having me here today. A kind invitation was extended by Ted, and we did go through what we thought some of the value we could add for you was in terms of a discussion about the market. One of the things that I am going to talk about today is the flow of new, principally institutional capital into the market, what that means for you, the markets, where they're absolutely competing with you and going head to head. There are some notable absentees in terms of geographies that I'm talking about. So if you're from Gippsland or if you're from Tasmania, don't be offended by that. But we see less institutional capital flows in those markets. You're really competing with your peers there. It's across those other beef markets where you're certainly in competition with really significant pension and institutional funds looking to get set in this space. In terms of the themes for today, we certainly are going to look at barriers to entry for you in terms of acquiring new land. I'm going to challenge some conventional thinking towards the end of my presentation and get you to have a think about, or hopefully take away some ideas about how you're able to expand your business without necessarily having to compete in a market where the economic returns start to get a little bit flimsy. And the other thing I'm going to suggest to you at the end of the presentation is have a good hard think about whether or not you need to be invested where you are, or whether or not you need to be invested in land at all if being a beef producer is what you want to do. You can't do a presentation on beef without talking about the Northern Pastoral Zone. Now, what relevance does that have to us? There's significant relevance. So we saw that in the live export ban and what that did to you guys in terms of commodity prices. It's absolutely relevant in terms of drawing more institutional money into the country. It's a highly institutionalised, highly corporate market, which is continuing to be institutionalised. Although I do note with interest that Consolidated Pastoral Company is now going through the divestment in parts of its portfolio. There's a bit more about that on Beef Central, I think, today, in terms of another purchase. And the purchases of those properties principally have been what I'd call large family corporates. The active market participants up there, and I'll go through what some of the money is behind them as well to give you a bit more insight. Hancock Agriculture, including S. Kidman & Co., joint venture with Shanghai Cred. That's obviously Mrs. Reinhardt, and so Mrs. Reinhardt almost single-handedly moved the needle 3 to 4 years ago and up until the present date in that northern market, and certainly the northern New South Wales market as well. A lot of the overhang that was left in that market was taken up very quickly by her, and she's absolutely dedicated to being in the Australian beef industry, both at the commodity and the premium end, and will continue to look to make investments as well, based on what I think I know about where they're going. Paraway Pastoral Company is a mirror fund. It's a Macquarie Agriculture fund, which forms part of Macquarie Infrastructure and Real Assets. That's what MIRA stands for. So what's little known is Macquarie is a red meat fund, beef and sheep in Australia, would be one of the largest agribusinesses in the country. I think they keep a lid on that fairly well in terms of just how big they are, but they'd be in the top 3 rather than, sort of in the top 10. Consolidated Australian Pastoral Holdings, Archstone Investments and Shimeo Group and Hugh family, they've come in here out of China and bought quite a significant footprint in Western Australia. NAPCO, obviously a QIC managed investment now. They manage a controlling interest in that business, absolutely interested in continuing to grow it as well. Hewitt Cattle Australia, Don't know how much you've followed about their journey, but as a private family, got backing from Public Sector Pension Investment Board out of Canada, and that's really supercharged where they are today. So they're absolutely in a growth phase and continuing to look at acquiring more properties and building their business. Rural Funds Group, so Rural Funds Group listed on the ASX is ticker code RFF. They sit there basically as a REIT-style investor, so they're happy to be a landlord, looking for long-term tenants. They've got a very diversified REIT business now across a whole lot of commodities, but beef's an important plank of what they want to do, both in the north and in the south. And you may have read recently that they also took on JBS's feedlots on basically a finance lease style deal as well. Australian Country Choice, the Lee family. This is one of my favourite businesses actually in Northern Australia. If you get the opportunity to listen to David Foote when he speaks, he talks about that business, rather than being an integrated supply chain, being a demand chain. Having your customer and then being able to solve for what your customer wants all the way back, right through to the cradle. Australian Consolidated Beef Holdings, which is the joint venture between the Lee family and the Acton family, that came out of a sale process that was run for the Actons some years ago, and Australian Country Choice stepped into that. Gun Agri Partners, with the Gun Agri Cattle Fund, that's got a whole lot of European and US, or North American I should say, institutional investment in it. They're operators, so they buy to operate properties, and they bought some land out towards Roma and some up further north. And then you've got the high net worth investors. Kerry Stokes is still in there, Andrew Forrest is still in there and buying other stuff. Brett Blundy secured Walhallow off Paraguay a little while ago and is rolling out, water and wire and continuing to develop that up. And then you've got the family corporates, the Sterling Buntines and the Harris family and those sorts of guys. Central Queensland. I think this is one of the toughest markets if you want to get a footprint in Australia. I'd say it's the highest dollar a beast area, dollar a DSE country getting around, and part of that is that gas and petroleum minerals type effect, coal effect in that market as well. So a lot of people receive payouts over time, or they're getting the annuity stream out of coal seam gas, and that's really a significant influencer in this market. Consolidated Pastoral Company, big footprint, Paraguay's there as well, Hancock Agriculture, Hewitt Cattle Australia, Rural Funds Group, and then the established families. And I'd have to say the established families in this market really do dominate. The institutions have pushed in there. They got in there certainly post the live cattle export while the market was down a little bit, but since that time, they find it very hard to go head to head and compete with the really well established families. Northern New South Wales grazing. This market's been pushed along in more recent times by what I'd call the Wagyu effect. And so Mrs Reinhardt and others, Stoneaxe Pastoral, even Wally Ray, those guys are coming into that market and getting a footprint, getting really well established and building out their Wagyu businesses. Paraguay Pastoral, significant investor there. Reefer Salutary, so Reefer's a Chinese fund that David Goodfellow started, Cameron Hall runs that now. Palgrove, backed by New Zealand Super. So as a seed stock business, Palgrove has taken on outside investment from NZ Super, and they've been a significant player in the market in the last couple of years. Stoneaxe Pastoral, backed by Rock Partners with First State Super. So Rock Partners and First State Super puts money into the operating entity there. You would have read a bit about them recently. They're also the lessee for some of the rural funds management investments. So Rural Funds Group's there. MH Premium Farms. So MH Premium Farms is owned by Sir Michael Hintz, hedge fund guy out of the UK, Aussie expat. And Sir Michael's had a proper dip in terms of getting a footprint in Australian agriculture across multiple geographies, and done a particularly good job. In terms of beef production, you would say that it's not a significant part of his overall business, but it's significant nonetheless. He'd have 4,000 or 5,000 black cattle. Growth farms and individual accounts. So Growth Farms originally incubated the Michael Hintz investments, and they do that independently now. Growth Farms also manage a number of separate and private accounts, mainly for family offices. And then you've got the families and the privates, including an array of Sydney and Brisbane-based high net worth individuals. So this is a market that those guys are really drawn to. A bit like South coming out down the Hume corridor coming out of Sydney as well, but without the same institutional impact. So you've got high net worth individuals, institutions, really established families all going head to head in that market. And notwithstanding the fact there's some climactic challenges an unusually dry period up through there. The market remains relatively buoyant, which is counterintuitive for a lot of us, but I think it demonstrates where things are in terms of a weight of capital. And then AAAW, Chinese group. Now, I will say, in relation to Chinese groups generally, you'll see them mentioned here. There are some really quite good businesses that have been built in that wave of Chinese capital that came out 3, 4 and 5 years ago. I'd have to say they're really quite absent in the market at the present time. There are some very real and significant challenges for those guys to get what I'd call real amounts of capital out of China and to continue to deploy. And so if you've had any anxiety thinking that you're going to head with a myriad of Chinese groups in terms of trying to get invested, your fears are allayed. It's more likely that it'll be, if it's outside money, it'll be a high net worth Aussie or it'll be an institution principally out of North America. Western District, Vic and South East South Australia, for all intensive purposes, I call this the same market in terms of who the players are. Paraguay again, constant theme, Paraguay's everywhere, yeah? A mirror fund, Laguna Bay Pastoral Company. So Laguna Bay invests money on behalf of the Washington State Investment Board and some other investors. Banningall down in Western Victoria and a fair bit of other country as well. Midfield Group, MH Premium Farms again, all those other established families. Reefer Salutaries there, Dunkeld Pastoral, so Alan Myers QC is particularly active in that part of the world. Tianyu Wool, Chinese group again. Australian Agribusiness Group Investment Management on behalf of AP1. So AP1 is one of the Swedish buffer funds. They're particularly active in the high rainfall zones. Love Western Victoria, South East South Australia, Southern WA, Southern Australia generally. They're selling some land at Holbrook at the moment. And Thomas Foods International, we sold them Mount Shank last year and they're continuing to accumulate a lot of land in that area. The key drivers for demand. Well, the first one's a no-brainer, low interest rate environment globally, a whole lot of quantitative easing, a whole lot of money being printed. Any time you have that, in the whole history of capitalism, there's always a flowing into real assets. So in all of those funds, there's a higher allocation to alternate and real asset classes. So agriculture as an investment sits in different buckets in different funds or with different institutions. It sometimes sits in the alternate bucket, which is everything that they can't find a home for. It sometimes sits in the infrastructure bucket, which makes no sense at all because, freeways and pipelines and whatever else give 8, 10 and 12% return. Does ag do that? Not as consistently. But because there's higher allocations of money into the real assets pool or the alternates pool out of equities, there's a big race on for that money to be deployed. I don't think it's any secret that Public Sector Pension Investment Board in Canada has several $1 billion that they want to deploy. And so in Australia last year, they were a very, very significant investor across all their platforms in terms of investing new money into agriculture. And I think you'll continue to see them being active going forward through the cycles as well, through the ups and the downs. I think in terms of our exchange rate, as long as we're below 80 cents and if we're looking like we're still going to continue to go down, that's more likely to accelerate more inbound capital, particularly out of North America, potentially Europe and the UK as well, than the other. There's a surge in interest in agriculture from the broader investment community, certainly until recently. Agriculture was the new black for a period of time. I think the long and rather pervasive, we call it an East Coast drought, it's almost all of Australia drought if you spend a bit of time getting around the country. I think that's brought things into sharp focus for a lot of people that had an aspiration to invest in ag that aren't farmers, professional investors, and I think there's a whole lot of professional investors out there that have either been out there on the capital raise or have deployed into their first investment and they've just said, whoa, hang on, let's just wait and see how this all pans out. The litmus test for agriculture being the new black for mine is the evolution of what's happened in the Australian Financial Review's Monday paper. So I don't know who of any of you read the Australian Financial Review, but Monday's become Ag Day in a national financial paper, which is quite remarkable. So it's not unusual to see 1, 2 or 3 pages of articles and advertisements, and we've driven some of that as well. We've certainly taken a significant amount of ad space in the AFR for our institutional type sales. More stability in commodity prices. You might not all feel like that, but in historical terms there is. At sustainably high levels of value. Importantly and positively, a new generation returning to the land. So my challenge in employing smart young people 3, 4 and 5 years ago was smart young rural people being taken away by mining. My challenge today, finding young aspiring valuers or real estate agents to work in our team, is that they want to go home, and that's wonderful, but a pain in the arse at the same time. So the other key driver is until recently much greater liquidity in lending too. So up until the Banking Royal Commission, or approaching the Banking Royal Commission, it was significantly easier to borrow money. There was a lot of liquidity in lending. Barriers to entry or to growing your business. Record high land values and competition for land. There's absolutely no doubt that since the GFC, we've had a really significant run-up in land values. In the GFC, I'm of the view that in a lot of those high rainfall or established areas, even where the managed investment scheme companies were operating, we didn't see a massive correction in values. Values certainly went down a bit, but we didn't see a massive correction in values. What we did see was the market go into hiatus. And then there was this awakening, and for a period of time there, over the last 3 or 4 years, every time we sold a place or one of our peers sold a place, it was a new threshold level of value. There are still some pockets in the market where that's happening. Up at Holbrook at the moment, there's significant holding being marketed by elders, by Dave Giddos, and just upset that I didn't get, appointed to do that one. But anyway, I think you'll find that property will sell at a new historical level of land value for that market. Huge amount of demand, and that's despite everything that you're hearing in the market, the negativity about drought and whatever else. And so they've got a record number of inspections that have occurred on that place already. Western Victoria going from strength to strength in the non-dairy areas. I'll come back to the dairy areas in a moment. And you've got everybody into it. The sheep for wool guys, the sheep for meat guys, all your friends that you're going to be having dinner with tonight, your beef peers, the guys that want to do conversions of high rainfall land for cropping or dare I say it, the resurgent popularity of mixed farming. So the market's very, very strong, and whether you like it or not, and I'm happy for people to throw tomatoes at me, the market is the market. You can lament it as much as you like, you can say it's wrong, you can be pissed off about all the money that's coming into the joint, but the cold hard reality is he who has the gold makes the rules, and if you're missing out on places, you're missing out on because someone else is prepared to pay more than you. So the next barrier is obviously the persistent drought, the cost of feed, adjustment irrigation water. Very hard for you guys to make decisions about maintaining your nucleus and feeding through. I don't think that's lost on anyone. Very hard to pivot when you're committed to your bloodstock. Access to debt. So we'll talk about this a bit more in a moment, but certainly it is much harder to borrow money. And if you've already been on that treadmill and you're sort of entrenched in terms of where your working capital facilities are up to and what your balance sheet looks like, it's very, very hard to access additional debt either to deal with the drought or to continue to grow. Obviously, the pendulum will swing at some point in time, and given that we've been chopping the heads off a lot of females, in terms of the physical amount of breeding stock that will be available, livestock prices are no doubt going to be expensive during the inevitable recovery, and so that's going to create a whole other issue for you. You've got through, how do you sort of buy in and continue to grow, and then one that a lot of people, aren't aware of until they're trying to really push that growth curve is people. What's that do to your family? Who's working hard and who's got to work harder? Contractors and availability of contractors in some market segments, particularly if that market's been down. You want to start to suck up more competent people to assist you, and it's hard to find them. Staff always, doesn't matter what industry you're in, staff always are a pain in the arse. Very hard to find. And then the other service providers too, whether or not the professionals exist in your particular geography to help you, financial, legal and those sorts of guys. You are finding a retraction in some of the regions, particularly the ones that are affected, where you might have a group of older accountants, lawyers and whatever else retiring and not a lot of young people coming in behind them. Getting funding post the Banking Royal Commission. Debt is cheap and it's getting cheaper, but it's bloody hard to get. So it's almost the old umbrella and reigning scenario. Unless you're category A and probably don't need the money, it is hard to get the money. Now there'll be bankers possibly here today. There'll be bankers who are mates of mine, and my own bank says to me, no, we're open for business. We're ready to go and whatever else. They are open for business. They all want to continue to grow their book. They're all dedicated to making sure that they've got an ag book, but anyone that's tried to borrow some money in the last 6 months would be acutely aware that it's taking much, much longer, and that they want to see some modelling, they want to see a business plan, they want to see a whole lot of stuff that some of us just aren't equipped to give them easily, and we need to get some external help to put all that together, which costs time and money again. So it is much harder to get money. If you're not a Category A borrower, you may need to consider alternatives and think outside the box. So this is all about if you're trying to buy some additional land. Ask for extended vendor terms. You don't always have to pay interest to a vendor. So what do I mean by that? So there's a lot of vendors out there who are in their 60s, 70s, 80s, 90s, 100s, whatever, who simply want to get to an arbitrary line in the sand in terms of the value that they want to achieve for their life's work or multiple generations of work. And so it could be as simple as saying, well, I'm not a seller for anything less than $5,000 an acre. You can give that family $5,000 an acre, the vendor family, if you structure the terms right. It might only work for you at $4,000 an acre. But if you're on a pay-as-you-go type program, I've called it there a lease to own, where your lease payments are tax effective for you but are really reducing the capital sum at the end or what your take-out price is at the end. There's a whole lot of structuring that you can explore with a vendor that might deal with the circumstances they have around capital gains tax, your own cash flow issues, what they want to achieve. There's a whole lot of vendors who have anxiety about ending up with a bank account full of cash. A bank account full of cash that they're not going to get much money for, and end up being in an investment that they're unfamiliar with. Am I running out of time? 10 minutes, righto. I'll see if I can drag it out. A lot of people, that's a major point of anxiety for. The conventional wisdom back in the 80s and 90s was, sell your farm and buy some shares and retire, or you have this diversified portfolio or whatever else. In the 2000s, I think a lot of people are unconvinced about equities, and they quite like the idea of owning their land. So they may be your bank. They may want to just sell down over a period of time, sell down on a titles basis. There's a whole lot of thinking that you can do in terms of structuring to meet the objectives of the vendor, which aren't always about price, and meet your own objectives as well in terms of being able to give yourself some runway. Leasing on long terms, I think, is a great idea. You don't have to own land. It's great to own land, but if you're truly committed to building your business rather than building your real estate assets, then leasing, I think, is a really, really effective way to do that. And as there's been more and more non-farmer money come into the market in some of those markets that are either close to the metropolitan areas or whatever else, there are really, really good opportunities to lease land that's proximate to you, where you've got a non-farmer owner who actually needs someone to manage the land, incubate the land for them. If you're in a market that's gone bananas, it's gone past, what's a rational level of value for you to pay to buy out a neighbour to earn a return. If you're in that bid rent area out of one of those capital cities where you're surrounded by lifestyle purchasers and hobby farmers and rich knobs from town, that Collins Street farmers that just want to own some land, and it's gone past a frontier that makes any sense to you, this is going to challenge some of your thinking. Then my view is you should sell the place. If you want to be a farmer and you want to grow beef, and your land's now too expensive to do that, notwithstanding the fact it might be a multi-generational asset, then you should sell it, or you should use that asset to leverage yourself into land that does make sense, that's not influenced by those non-agricultural drivers. Doing the same thing but expecting a different result, I think that's the definition of insanity, isn't it? So stop flogging the horse of its dead. I hear these laments all the time, that guy's paying too much, or that outside money shouldn't be allowed to do that, and all these things, the shoulda, woulda, coulda, whatever. The market is the market. You've got to get over it. Do something different if you're locked out of a market that you want to be in, and try and look at other land markets. Now, we talked about southwest Victoria before. There's a great swathe of southwest Victoria which is, traditionally high value land, very high rainfall land, good safe country, but which has been basically in a holding pattern since the global financial crisis. That's all that dairy country down there around Simpson and that part of the world, the old Heytesbury settlement. Those guys have had really stretched balance sheets for a long period of time. That's a market that I think if you're looking to expand, you should be looking to go into. And even if you don't buy the country, go and lease it, go and do a terms deal. Big opportunity down there. The other market that I think you should look at, I'm doing this on personal account too, so there's a conflict, is the Northern Victorian, Southern New South Wales dairy market. So There's a whole lot of structural reasons up there in terms of the size of farms, irrigation water costs, delivery share, blah, 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 all those things, stretched balance sheets, people in distress. You can go up there at the moment and secure significant amounts of land for anywhere between $1,500 and $2,500 an acre. And a couple of partners of mine and I have done that to the tune of 6,000 acres in the last 6 months. And we think we'll probably have somewhere between 8,000 and 10,000 acres by Christmas. So it's a market where there's a lot of land available. It is easy to be able to structure some terms that work for vendors and you. You've got some vendors that really are looking to get out there that have had enough. And it's not because they've gone broke necessarily. It's not because they're under financial duress necessarily. They've just had a punishing, 10 to 20 years. And many of them had enough, or they're at an age where they're ready to go. So that's the secret in my mind. You're not necessarily going to get what you want in terms of safe country, rainfall country or whatever else, but there are opportunities to get out there and buy some land which is relatively cheap, and you just got to break with your conventional thinking, I think, and take that opportunity. And I think that's questions and abuse.
So I've got one of the roving mics and there's somebody else at the back that's got one as well, Joe. So any questions for Danny? Beautiful.
Actually, I've got a question. Tess, can I have a yellow sticker so I don't get filmed?
Danny, James Knight from Mortlake in southwest Victoria. Thanks for your presentation. Danny, I've got two questions. The first one is, what are the attributes of those land assets in the northern pastoral zone that make them attractive to corporate investors, and we see them climbing all over each other to get them? It's the first one. The second one, I agree with you, the access to capital and through the banks. As young people in ag, there's a number of those organisations you put up that I know have established family structures that have reached out for external capital. What have those families done well to demonstrate that they can return for the investor?
Might answer the second question first, if that's okay. I think they've demonstrated just exactly what you'd need to demonstrate if you were going to the bank for money. It's the old 5 Cs, I'll forget half of them. Competence, creditworthiness, capability. They've been able to demonstrate that that they understand money, they understand what the investor's going to do, they speak the language the investor speaks, or they've engaged with Ernst & Young or PwC or somebody to help them explain to the investor that they understand. And so you need to be able to demonstrate a period of performance in your own business, just as you would if you were going to a bank. And you need to be able to demonstrate what you think you can build if they're able to put that money into you. Bear in mind, there's a few traps. Like, it sounds fantastic, bring in some external investment, happy days, we'll grow a business, that's great. You lose control. And equity is more expensive than debt. So what you'll be giving away when you bring in that external investment is absolute control, and the things that you've been doing because of your intuition or instinct, monthly in a board call or a board meeting, you'll have to be sharing with them and saying, right, this is what we're going to do now, even though you would have in your own business just gone off and done it. Or you would have a talk around the kitchen table and gone off and done it. So there are some pitfalls or some things that you won't like if you're bringing that money in. That money does expect a return. So whether it's this year or next year or sometime down the track, they'll expect a return. And at some point in time, they will want to have a managed exit, as you may want to have a managed exit. So you need to be talking about the divorce or what the exit looked like or whatever else at the front end of that conversation as well. Don't know if I answered your question properly, Jones. Yep. And then the second part is Northern Australia. What's the allure? There's nothing better than when you're flying into a cattle station. You're in the Pilatus, what's it, PC12 or whatever, and you're coming in your bank and you look over out at the cattle yards and there's 1,000 or 2,000 or 5,000 or 10,000 head or whatever they've bought up, that they're going to deal with. You go, shit, look at that scale, and we're at the doorstep of Asia and it's fantastic. I've got no idea what draws the investment to it, apart from romance and bullshit. There's heaps of reasons for people sitting in a desk in North America or wherever else, to think, or China for that matter, to think, geez, that's a great place for us to go and invest. But if you look at the returns of all but the really good family businesses up there, like MDH or Stanbroke, if you look at the returns of just about all the others, I'd have to say I think they're probably underwhelming if you strip out what the capital gain on land has been. So, you know, I don't understand why they want to be there, but again, just as I've said and lectured everybody earlier today, the market is the market. They want to be there. It's a bit of a valuer's lament, you know. I've got a heap of valuers that work for me. I'm a broken down valuer. Sold a lot and became a real estate agent. But the valuers in my team often say, oh, geez, the values don't make a lot of sense, and some of our peers say the values don't make a lot of sense. Well, the values are what the values are. You know, that's what they're prepared to pay, and they're the returns that, you know, they're prepared to accept. So, you know, in short, there's probably a limited number of opportunities up there and a significant weight of capital that wants to be invested. We might have just hit the end of that weight of capital, if you know what I mean. It'd be interesting to see where that market goes from here. It doesn't necessarily mean there'll be an adjustment downwards in price. And CPC's break-up sale, the thing that they're going through at the moment, demonstrates that if you make those assets a little bit smaller, you know, they're still 20, 30, 40, $50 million tranches. This is a big tranche over in the VRD, 120 or 30 million to the Vietnamese group, that the demand is still there.
Thanks very much, Danny. And I reckon that's about all we've got time for. So I might just ask if Danny's going to be hanging around for a little while to maybe answer some questions out of session, or are you heading straight back?
I've got to do a deal, Mick, yeah.
Can we fit just one more in, Joe?
I was just wondering, as regards financing, interest only versus capital repayment.
It's really horses for courses. You know, if you can do a principal and interest loan, then it doesn't matter what investment you're investing in, your house in Toorak or bloody whatever, you know, then you should be doing a P&I. But, you know, interest only has its place in periods of time where you want to take that big bite and accelerate your growth. So if you need to do an interest-only loan, you know, for 4 or 5 years, you can lock that in at, you know, relatively cheap rates at the moment. There's nothing wrong with that at all. If it allows you to, you know, manage what's otherwise your working capital requirements or whatever else. But really, interest-only, you are punting that the thing's going to go up. If it goes down in value, if something happens, you know, that can have a significant impact on you as well. So principal interest is always favoured, but yeah, that's significantly harder than interest only. I don't know if I answered your question.
Thanks very much. Can we all just give Danny another big round of applause?